What's up, guys? It's Ron from Ron Rohde Law, and in today's video, we're going to be interviewing Jeff Rohde. He is the CIO of investments at Pepperdine University, and he's in charge of the university endowment, which includes a lot of direct real estate as well as secondary LP positions. So, Jeff, welcome to the channel.
Thank you for having me, Ron. It's good to be here.
Yeah, well, I guess if people don't notice, we do have the same last name, and I'll go ahead and put that disclaimer. You are actually my brother.
That is correct.
All right, but let's talk about. Tell me what your job is about, because I think people think of university endowments and they don't really understand what they do. Right? They invest large amounts of money in massive projects, but is that is that all it entails?
Yeah, I mean, it differs by university. So for us, I'm the chief investment officer, so I oversee all of the investments of the endowment. That's predominantly, think of your stocks and bonds and alternative investments. I would say one misperception that a lot of people have is that the endowment is comprised of gifts almost entirely. So it's not, profits from tuition or anything like that. That is spent. These are the gifts that we have to allocate in order to support scholarships and operations.
So how much of your incoming revenue each year you're saying is that returns on investment versus gifts, like new money coming in?
Yeah. So for us, we pay out about 5% of our total endowment every year to the university for scholarships and such. Um, it varies on fundraising, but I would say we bring in a little less than that on an annual basis. So we've got to make up the difference in returns.
I see. Okay, so that's the return pressure on you. If you can share, if it's is it publicly available? What's the total assets under management right now?
Sure. We manage about $1.2 billion in under my kind of purview.
And relative to the CalPERS or the UTs, even Harvard, where does that rank, I guess, in terms of universities?
Yeah, I mean, you named some of the biggest ones. I would say we are small to mid, right? At $1 billion, that puts us in the smaller range. As you get larger, you've got different objectives too, right? Harvard has more gifts coming in than they pay out. And so they've got different objectives, different team sizes and compositions. So with $1 billion, I've got three directors, a deputy CIO, and three directors that manage the portfolios. Whereas if you are a CalPERS or a Harvard, you can have a really built out staff.
Do you think having more staff generates higher market beating returns?
Yeah, I'm getting right into it. I don't actually. In some ways, there's tremendous advantages to it. When you look at size, you can negotiate preferential terms. But sometimes that's also a negative kind of selection bias, right? So if you look at the best firms in the world, we'll just take hedge funds or something like that, the ones that are willing to make deals for the large pension money sometimes aren't the best, right? I think a lot of our managers have overcapacity issues. So they don't actually want another $10 billion because they can't put that to work efficiently. So you do have this selection bias where we think we're investing with the best managers in the world. They have enough capital, right? For them, it's not about can we get any more capital. It's can we deploy this, profitably. So I think there are some downsides. On the other hand, you can save costs just with economies of scale. So I like where we sit.
Yeah, I also think of it too. Investing is really about not just what your potential return could be, but what is that variation, what's that standard deviation of risk. And so maybe having a larger size as well reduces the risks without necessarily hitting higher peak numbers. I think as an endowment, is that more attractive?
Yeah, no, absolutely. And for us being smaller, there are investments that we've had that have been quite lucrative that other large endowments couldn't fit into their allocation. It just wasn't big enough to make sense or move the needle. So yeah, that's definitely a differentiator there.
Are those like startups? Are you talking pre-IPO, or what's the most lucrative example?
Yeah, I mean, it's basically in every sector. So a lot of startups, yes. When you look at, I would go even to some real estate deals where we have real estate deals that are smaller that really CalPERS isn't going to look at. But for us, if we can double or triple our money in a few years, uh, that actually it's meaningful to us, even if it's just a few $1 million. Same with kind of oil and gas. We've had some deals where you know, we were capacity constrained. They couldn't take any more than a few $1 million, and so we maximized that. But there's no way they're going to fit $100 million in there.
Interesting. So let's keep it going down the real estate path. I know people that subscribe to this channel are all real estate investors, or they like commercial or industrial real estate. For that deal that you invested in, was that a direct ownership role or something that you guys invested as an LP?
Yeah. So the majority of our investments, we come into fund investments as LPs, limited partners. With that being said, we do some direct, mostly local deals that we'll do direct, or we'll co-invest alongside our partners. So if they have a good deal, we can kind of underwrite that alongside them and see if we want to make a concentrated investment there.
Will you also do an LP? You're talking about like a sidecar in addition to an LP placement, or GP only?
Yeah, generally an LP position, and then if there's a position in the fund that we think is attractive on a standalone basis, we may increase our concentration.
Okay, awesome. I mean, what are you guys looking for in terms of the market? Everybody knows the plight of office. Everybody knows multifamily is hurting right now. Industrial is really the only bell of the ball. What asset class are you guys targeting?
Yeah, no, we have a pretty unique portfolio in terms of our real estate allocation. We've got probably about a third of our real estate portfolio in telecommunications infrastructure. So think of cell towers, digital infrastructure, some data centers, a little bit of fiber, not a ton of fiber, but that's a large position compared to our peers for sure. When I look at kind of asset allocations, we don't have a ton of office, which has been beneficial over the last few years. Um, and the office that we do have is predominantly medical office, which has weathered fairly well. And we don't have a ton of retail either. So some logistics, digital infrastructure, and kind of some other debt structures as well.
So for those data centers, are you guys investing in new construction, or is it just stabilized portfolio?
Yeah, a little bit of both. So this is where we kind of farm this out to our managers, our investment managers. Some of that, it can make sense if you've got terms agreed to and you can actually build that. I think when people are building on spec, they ran into some issues. It's a very complicated sector, in my opinion, with technology changing and the need for latency and energy. Right, we're seeing a huge demand for energy, and that's really driving any new developments. You got to have water and energy, and uh, we leave that to our professionals.
Yeah, I just wasn't sure if when you guys make a evaluation and the manager says, I invest in data centers, you say, great, we want to invest with you to invest in data centers. Do you draw a line to say we only want the stabilized lease data centers, or can you mix our money and put some into speculative development versus you want no all development? I find that is interesting because in my world, the investors who do development risk are very different than the coupon clippers that want a stabilized asset trading at a premium. There's no real action. There's no skill involved in improving the value. It's just manage it well and operate it efficiently. And you need to pay attention. But do you guys feel like you have two different buckets, or do you just throw that into the manager and say, hey, give me a blended return on data centers, give me a blended return on telecoms?
Yeah, no, you're absolutely right. It depends on your targeted rate of return. And so everything's a risk adjusted return from our perspective. What I would say for us, we try to find a sweet spot between, uh, where we have a pre-leased site and we just have execution risk. To me, that's the optimal kind of balance for us, where if you do what you say you're going to do, get this built, you have a tenant that's ready for it. Versus, like you said, I think a lot of people did get in trouble just buying kind of core safe assets because of interest rates. So that doesn't really appeal. We don't have a ton of core. I think we have very little, if anything, that I would consider core unless we're selling it. So there that value appreciation between taking some risk, stabilizing it, and selling it is our kind of sweet spot.
Yeah, I mean, even on the build to suit, you may have a pre-lease, but you have execution and then you have possession risk too. The tenant can back out as well. So sometimes that can be more frustrating because you're kind of locked in on this guy who now changes their mind and says, actually, we're not going to take possession, and you haven't done a lot to market the property.
Yeah, no, we wouldn't do any, like I said, spec build without a signed kind of contract. So that
Okay.
would go to the
Okay.
lawyers and
Well, what are your thoughts on rate cuts? I know that if you would have had this conversation with me 6 months ago, I was pretty bullish and I said, yeah, we're going to get one or two rate cuts before the election to juice the economy, yada, yada. It made sense as a good story. I turned out to be completely and utterly wrong. But what are your thoughts on US rates vis a vis the rest of the world?
yeah, no, you weren't alone, right? And I wouldn't say the book isn't written yet, right? We do try to avoid predicating our investment decisions on macro decisions like that for that reason, right? Is I think there's a lot of reasons to have expected rate cuts. Counterpoints are inflation, um, and we still may get that rate cut by the end of the year. Um, for me, interest rates are everything. When you look at distress, almost all of the distress, at least the significant distress, is caused by interest rates. Right now, that's not just, hey, my cost of debt has gone up, or I can't resell this for a profit because of interest rate movements. Right? They can take a 5% guaranteed Treasury bill versus my property or company. Um, but it drives malinvestment as well, right? So when allocators are looking at opportunities and you've got 0% interest rates, um, you're going to start stretching a little bit, right? And that's just basic psychology. And it's something that we wrestle with all the time, uh, you know. So when people make these malinvestments, it really uh, it kind of closes the opportunity set for outcomes, right? It constrains it, puts a time pressure on it, and then you see some investments like you've seen. I don't want to specifically talk about any sectors, but some of the more speculative assets like crypto, and some of these other companies we saw back in the meme bubble, where the valuations didn't make any sense, and that's, I think, mainly due to interest rates.
You mean like NVIDIA?
Nvidia is interesting, right? When you look at their growth projections, and I'm not an expert on Nvidia, but when you look at their growth projections, they could continue to grow at a amazing rate, and the stock price could go down 50%, right?
Oh,
So,
that's interesting. Yeah. Well, the stuff about NVIDIA is interesting is that it also assumes no other competitor comes in to take market share
right,
because, yes, they are the best. Yes, they are the only best player, but it's not a guarantee forever. And
yeah,
I think that's what people don't account for in their investment horizon, saying, stocks just go up. And it's like the GameStop meme all over again saying stocks go up, real estate goes up. What do you mean analysis? What do you mean hold period? And I'm just saying it's crazy how long the market can be irrational because it's not supported by anything. It's Nvidia's a more valuable company than like the UK and Germany together, their stock exchange.
Yeah, no, absolutely. I mean, I think, over the last decade, you've seen this easy money kind of environment. And so that's led to this speculation. It's led to these asset prices that have just gone up, it's almost regardless of fundamental performance. I think what you just hit on is one of the big kind of truths that we have in investing, which is the most mean reverting metric is profit margins, right? In a free market, people will see those and say, "Hey, I would like a part of that," and they will create competition. So absolutely, and you haven't seen it really in Nvidia's case, but given enough time, there's going to be people that are jealous of those margins and those returns and saying, "Hey, like I can do this just as well as them, if not better." Um,
And they already have competitors. I mean, it's not even like they invented GPUs. There are other people that make GPUs. They're just allegedly not as good, and they didn't lean into the AI computing. But I read a good article that said it's very circular of when you provide good hardware to the users, like the technicians. Um, they tend to like that because that's what they're comfortable with and that's what they're good at. So then they just tend to order more of the hardware that they're used to, and it's a self-improving circle of, well, the guys like it, so we order it, and then the guys like it, more people get trained on it, so then they like it, and it's just a circle virtue of nothing. It's just people's inherent laziness, which I guess is maybe a good bet.
yeah, well, no, it actually brings up an interesting story we have where you have to entice them. You have to give them a reward for changing from their routine. We were fortunate to invest in SpaceX really early on. And I remember trying to get those government contracts. We almost got blocked out of a lot of those processes until I think there was one individual that said, "Wait, we got to look at these guys because their bid is coming in at a tenth of what our other um, bidders are bidding these contracts on." And because of that was the only reason. Otherwise, we'd have just got pushed out as a new guy, upstart. Don't bother with them. We know these people, right? Um, and so you have to entice them, and it'll be with a better product, a better pricing, whatever it might be. But that's the free market.
Yeah. So again, in real estate and investing in general, when you're saying interest rates are high, there's fewer people to do that price discovery.
I think when interest rates are high, people are more discerning, right? Is it is a legitimate option to say, "Hey, I can earn 5% here and sleep at night," versus when interest rates are at 0%. That's not a really attractive option to say, "Well, I can live off of this earning, 0.5% or 1%." You just can't. So you're almost forced to allocate capital. Um, and that's actually the policy, right? Is to encourage people to borrow money, take risks, stimulate the economy, spend money. That's the goal. And so that's why you've got the inflation aspect of this as well.
Yeah, but I think it's interesting what the Fed did is it really did the double whammy of too much money supply, which inflates prices, plus the low interest rates, which stimulates demand and forces people to come out of their caves, come out of the rocks, and take some risks. So it was really I think, a terrible management decision to do both of those, because now we're coming off of that free money, lots of money chasing deals because they're also motivated to get out of the caves and look for things. And now it's just coming. I would say it's come crashing down, but it is a very fragile economy that you know I don't see. I don't know what's going to happen, but it sounds like there's a lot of risk out there.
Absolutely. What I'd recommend you look into is kind of government spending as it relates to unemployment. Historically, what you'll see is that as unemployment rises, you see government spending increase dramatically, right? And as unemployment comes back down, times are better. Spending kind of comes back down and back into trend, I'd say, not down, but in line with trend. What we saw with the last two kind of administrations with COVID, you saw unemployment spike a little bit. You saw spending go through the roof. And then as you saw unemployment go down to historic lows, right? Economy is doing well, kind of stock market's doing well, real estate prices are going up. We saw interest rates stay where they were and government spending increase. So it's one of if you look at a chart, if you can visualize this, uh, you just have these cycles where unemployment's up, let's fix that, let's work on that, and then we go back down. In this case, for the last two administrations, we had unemployment go up and then back down, and spending just kept going and gapping out. So absolutely, that's a concern. That's our rainy day fund. That's kind of the resources when you need them, and we're spending it. We're continuing to spend even as the markets are okay.
So, so what would you do with that data and the conclusion that you're drawing? It's definitely negative. What would you do as an investor? Because, you know, I think there's a little bit of fear, and I don't want that to discourage people from investing. But just as a, caveat before you answer that, I feel like I pulled away from equity positions for 2 years and I stopped buying real estate, didn't buy any industrial. Instead, we loaned. And so we took a senior position, low LTVs, yada, yada. There were industrial assets, but we switched from equity to debt for a fixed return and some fees in exchange for no upside. And I think we did that for a while, but do you think that's what's your advice for a real estate investor given that conclusion or observation?
Right. Look, I think that's what you led this conversation with, expecting rate cuts. I would argue that the reason you didn't see them is because of this action by the Fed, where they're saying, "Hey, look, if we do cut rates, we're already at all-time highs in the stock market. It'll propel further spending, further inflation." Um, that's probably not necessary right now, and so that's why I think we were a little more bearish on these cuts, because the inflation number maybe is even being understated by official numbers. But because of that inflation and the existence of it in the spending, we were a little bit more wary about hoping for these cuts, right? I know there's a lot of investors out there that are really banking on rates going down. At least, give me one more shot at these low interest rates and I can refinance. And
Well, some investors need it. Their buildings can't cover a higher debt service, and the DSCR is negative. It's 0.9. It's not even covering at what the markets are lending at, and so they need it, or else they need to sell the property. Short sales. We've seen a fair number of foreclosures. Typically, all the pain though is in multifamily, related to very expensive rate caps. Rents went down, property taxes and insurance went up, and they were just facing huge windfalls. Headwinds. And so they just gave the properties back to the lenders. We're not seeing the operational mismanagement yet. And the longer these interest rates stick out, even the best operators can't quite make it work because there's an assumption that the rates will come back down.
right. Yeah, when you look at kind of market corrections, just in general, right? A lot of times people look at the max drawdown, we'll just say, right? Is how steep the things drop from the highs. Um, the other component of that is the duration. Is how long does that drawdown last? If it's 6 months or 3 months and you're back, um, you know, fundamentals have shifted and everything's looking good. Most people can survive that, right? Some can't because they're just over levered, but most solid investors should be able to survive that kind of process. If you have a even a you know a more mild sloping downward sloping curve there, but it lasts a lot longer, then yeah, you're looking at maturities. I mean, I think we've got like $1.5 trillion of commercial real estate debt kind of maturing in the next 2 years, right? So if this period lasts, where say interest rates go up another 100 basis points, you can just visualize that distress that's going to come. So what we're looking at right now is it's really tough to develop right now. And when we look at opportunities, I like what you said about shifting higher in the cap structure. That is something that we are doing as well. looking at debt, looking at each of these, all the collateral, and saying, all right, if we have to, we can take the keys to this asset. How do we feel about finishing the construction, about repositioning it? Um, what do the numbers look like, right? If we do have to take over this property, and like you said, no upside. There is upside. I mean, we're getting paid to take on these, to lend this money out there. Um, but yeah, I think when we look at it, that makes a lot of sense where we have yields that we're happy with. It's not going to knock the socks off of anyone, but solid returns. And then in the event of, a major distress event, uh, we want to have kind of the newer construction if it's a multifamily building, and we come in at a lower basis than existing buildings. We can offer lower rents and newer construction. That's where we want to be when times are
Right.
tough. So for us, that is something that we are actively looking at. We are positioning ourselves to be lenders, senior lenders, um, with an eye on, okay, if we have to take over this asset, maybe not optimal, but we're okay with that, and we have the means to operate it. Um, so yeah, so that I think we're very aligned there. A little higher in the cap structure. You've had years, many years of solid performance. I think now is not the time to get greedy and roll the dice again and say, hey, let's go. Trees can't grow to the sky.
Real estate only goes up, though. I think I'm encouraged. GameStop's back up too. So
Look,
we're
you've
back.
got you've got places like New York and San Francisco, these gateway cities that people thought the same thing. And you're looking at some of those haircuts that they're taking, and the banks are in trouble, right? When you look at where these loans are concentrated, it's the small community and regional banks that have this disproportionate exposure to commercial real estate, and even some of the CNI kind of loans. Um, when you compare those to like the large banks, I think it's like 4 or 5 times the magnitude in terms of percent of the portfolio exposed to this. Um, and so that could be, if it's not already, your next crisis, where these regional banks are having to deal with all of these properties getting handed back to them at in a period where people don't want those assets, right? So they can't just flip them like they would want to. They don't want to operate commercial real estate. They're banks. They
Yeah,
don't want that.
no, and I think as a lending, you have to get pretty big before your REO department is capable and experienced to handle those. I think they have been trimming those departments for the last 5 or 6, 7 years because they have no activity. Why do they need 7 different people to specialize in multifamily and retail and industrial and in data center and new construction? They're like, we just need one guy. He can kind of do it all because you've got 2 files a year, 2 properties, and now we're looking at 2 a month, and
Right.
what's going to happen? So there's definitely opportunity that if they can take a 60% haircut, but to get it off of their plate and just get realize some cash, there might be. Do you think that's considered the bottom when it goes back to the bank?
No, I mean, I would say when you look at some of these headlines, right, you're like this, hey, massive office building in Manhattan gets handed back to the bank, was sold for $100, right? Um, a lot of those, the banks are going to take a loss on those, right? Even though they are, that buffer capital has been eliminated, they're still going to take a loss on these most likely. So I think the bottom is you got to buy those at a discount from the banks, um,
Okay.
after they've
Yeah,
had
I
to.
mean, we're seeing some of that trade in like North Texas, for example. It's office buildings are trading for land value, and it's truly the land value plus construction plus demolition plus soft cost plus permitting to build an industrial warehouse. And when it's trading for like $32 a foot to the building because somebody is penciling in an exit at 210 a foot for an industrial building, they're saying, and now I have enough spread between $44 a foot and exit at 210. um, that's what we're seeing, and we've already seen several suburban office campuses get demoed for industrial.
Yeah, no, I think you could see more. there's obviously risks involved in those redevelopments, but absolutely, I don't think we're at the bottom if that's what you're asking. I'm fine if we are. We've got plenty of exposure, and we'll be happy. But it doesn't feel like that.
Interesting. Interesting. Well, I really enjoyed the conversation. I feel like we went down the real estate, but any parting words for people, lessons that you can learn as a small real estate investor from Jeff Rohde, the CIO for Endowment? Yeah.
Yeah, I think I'd just try to quote smarter people than me, but manage your debt situation. Don't put artificial timelines on your liabilities, right? That just increases the level of difficulty substantially. Um, I think Morgan Housel talks about, the more debt you have, the more limited number of environments you can survive, right? So uh, I think about that a lot. For us, we have a mantra which is, take care of the downside, make sure you survive that, and the upside will take care of itself.
Hmm.
And that is how we invest for the long term, right? This is a perpetual pool of capital, so we have time. We want to think about this. I'll leave you with a story. I think my chairman of my investment committees talked about the other day. I think I'd read it from Howard Marks, but it's talking about the manager of the General Mills pension, and he had retired after a 14-year kind of career as a CIO. And he said over that 14 years, relative to peers, he was never above 27 percentile. So he wasn't top quartile ever in any given year, but he was never below the 47th percentile. So above median seems very average, right? And I'll let you guess here. After 14 years of doing that, what do you think his 14-year kind of percentile ranking was?
Number one.
It was fourth. So I think you're on the right track, right? Which is top 5%. So when you see a lot of these people on social media talking about these huge home runs, like I'm guilty of that as well. We've had some home runs, and they make you feel good. But realize that those people that are in the top 1 percentile, top 5 percentile, they generally tend to be also in the bottom 10 percentile at some point. So I would say keep your head on you. Be wary. Don't believe the hype. Don't drink your own Kool-Aid. Um, and like I said, focus on the downside, and the rest will be good.
Awesome. Well, I appreciate those words. I'll put your LinkedIn or something, and definitely the Howard Marks Market Cycles book is great. So I'll put a link to that down below. But thanks for joining, and we'll see you next time.
All right, take care. Good to see you.